Bismillahirrahmanirrahim. Subject is corporate governance and social responsibility. And today lecture is on committee of a board or board level committee. I'm Majidullah Khan, Assistant Professor, Institute of Business Studies, Quad University of Science and Technology, Guwahati. Topic to be discussed in today's lecture, committee of the board, issue and problems, common committees, the audit committee. Since board of director is a non-executive body that meets no more than 4 or 5 times a year to perform its oversight, directional and advisory function. The time at the disposal of the director is rather limited, in fact too limited to allow comprehensive coverage of all the various issues that are presented to the board. It is therefore necessary that the board should get some assistance from certain committees or subcommittees other than management of the company for expert advice or briefing on any specific issue. Forming a committee of the board is one way to getting such an assistance. Some of these committees may be required by law, while other may be formed purely as a convenience and tool for better governance. So, some committee are required by law, such as Audit Committee, Remuneration Committee, and Financial Reporting Committee, and some for better governance. It is sometimes called also ad hoc committee for any specific issue. What are the advantages of the committee? The director are able to get impartial yet professional input from source other than the management of the company. If a board continues to rely solely on information provided by a management, it will fail to perform its function of effective monitoring. A board that does not look behind the paper presented to it by the management will not be able to control the management. Rather, the board will be controlled by the management. So, the reversal of the role is against the spirit of good governance and should be diligently avoided. Hence, in this respect, committee helps to improve quality of governance at a company level. Second advantage is reduce workload. Detailed work is done by the committee member while the board receives summarized report, recommendation on any issue. This is not the dilution of the power of the board. Board retain its power to make final decision on the issue. The issue themselves are assigned to various committee in order to get detailed information on any specific problems. In this way, more work can be done in a lesser time by improving the overall efficiency of the board and hence efficiency of the governance. The third advantage is detailed and specialized information. The board can get more detailed and specialized information for more dependable decision making. This is the most important argument in favor of committees and role they can play in improving the quality of the governance. Board members should be provided this access to outside specialists without having to rely extensively on the company's own management in order to get independent views on the issues. So the work of the committee can be outsources. Moving further, what are issues and problems? Board level committee need to be handled efficiently by the board. So these are some practical problems that we will discuss that handle efficiently by the board. First problem is that committee are often accused of slowing down the process of decision making. Quite often certain matters can be decided by the board but are referred to the committee, which take its time in coming up with the recommendation for the board. Again, the discussion on these recommendations take more time than the discussion on the issue itself. It is not only governmental committee that is known for delaying the decision, but corporate committee are often as guilty as the government committee is guilty for delaying the work. So first is delaying decision is major disadvantage. Board member once committee is formed about a particular matter, many board members stop caring or even thinking about the issues. So they hide behind the committee recommendations. As it is, most non-executive directors are neither aware or non-concerned about their specific responsibility as a board member. Committee provide them an excellent means of escape because less than diligent director can easily hide behind the recommendation of the committee. If wrong decision is reached by the board and process of accountability begins, such director conveniently point at the committee and escaped uncaged. Third is, the fourth is lack of competence and skill in board level committee. Committee are often not competent, since most boards still confine the membership of their committee to its own member only. They may frequently fail to find sufficient talent in the board to constitute meaningful committee in a particular subject. Such committee may not have specific competence to deal with the matter referred to it. Forming committee that does not have adequate intelligent capacity to look at difficult problem is like going to an is just like having a tree without implanting a tree in a stone. In developing countries, committee fails to perform its function. That is another drawback or issues that are practically occurring in developing nations like Pakistan. When committee fails to perform its duty, it also prevents others from performing the function. This relates to those who are not in particular committee do not want to interfere in its work. This means that if the committee is not performing its work properly, the whole board and hence the company suffers. At the same time, those in the committee do not approve of other directors raising objection to their recommendation, even when such recommendations are not faulty. In developing countries, in Pakistan, board committee often become one-man show. The head of the family who own majority of the share tend to chair all the committee. I mean, they are a chairman in all committees. And even if they are not a chair, they are attending the meeting without being even if not a formal member. In this way, he controls all the committee of any real power, taking all the decisions individually. Even if the top management is not involved in such committee, certain committee chair tend to make their committee their personal domain and rule over it with strong hand. The effective committee, sarcastically someone said that what is effective committee in Pakistan? It is said an effective committee comprises of four members, three of whom do not give damn and one who wants everything his way. So this is the real situations in Pakistan. Committee are manipulated by management or executive in developed nation, while by controlling shareholder in developing nation. Board committee are manipulated by management of the company in developed nations, while in developing nation it is manipulated by controlling shareholder. Sometimes the family controlling company may form a board committee to give recommendation on new project and make sure that the recommendation is still in line with what the group really want to do the matter. Manipulation of the committee by crafty managers or controlling shareholder in a country like Pakistan is fairly common. Committee are used as a rubber stamp for decisions made elsewhere. Moving further. These are some common committees that are found in every country: Audit Committee, Nomination Committee, Executive Committee, Remuneration Committee, Compliance Committee. Sometimes company combine function of two committees into one, such as function of Compliance Committee and Audit Committee, functions of Remuneration and Nomination Committee. Audit Committee. Relevant laws of most countries are now required listed company to form an audit committee comprising of 3 or 4 members. The committee is charged with the responsibility to oversee certain function on behalf of the board and to brief the board thereon. Mostly members, even all members, are independent non-executive director. In particular, no executive director is made a member of audit committee to ensure its independence. So all members, this is a point, all members are independent, that ensures the independence of audit committee. The chairman of the audit committee must be an independent director. Sarbanes-Oxley Act of United States in 2002 requires that one member should be financial expert. Audit committee have a power to hire anybody or professional for getting its assistance in a certain matter. What are responsibility of the audit committee? Audit committee to oversight financial reporting and its integrity and overall accounting system. Liaison with external auditors of the company. Ensuring compliances in respect of disclosure and other requirement of law related to financial statement. Monitoring the internal control process of the company. Oversight the risk management process of the company. These are the responsibility that are enumerated by Code of Corporate Governance in the Board of Directors. So let us discuss briefly each of the responsibility. First one, oversight of financial reporting. Before periodic financial statement like income statement, balance sheet and cash flow statement are presented to the board at the end of each year or each quarter, these statements are presented are reviewed by audit committee so that it can brief the board on the validity and acceptability of such statement. The audit committee should have sufficient expertise to discuss the various accounting policy and standard that have been adopted by the company's management and to make judgment on their suitability to making financial statement. Particularly, they should go over the contents of external auditor's report to see if the company's financial statement meet the requisite standard or not. If the audit report is qualified means if auditor have any observation on the company, if our auditor point to any weaknesses in the company or any shortcomings in the financial statement, the audit committee should investigate the qualification of audit report to explain their implication to the board members. Second point is liaison with external auditors. In the process of the work of the audit committee, members of the audit committee can interact with with the financial management team and external auditor of the company in order to get all necessary information. Particularly, all communication between external auditor and management of the company must pass through the audit committee. This ensures that audit committee remain fully informed of all aspects of external audit and that management does not unduly influence the external auditors. It also enables audit committee to explain matter to the board of directors. Some common documents that are exchanged between external auditor and management of the board are management letter, which is also called letter of weaknesses, statement of weaknesses on internal control system of the company, primary audit, any initial audit objection prior to finalization that are discussed with the management. If such documents are confined to the management, the board will never know the relevant detail that might reflect on the quality of financial statement that eventually emerge out of external audit. The third point is ensuring compliance in respect of disclosure and other requirement of the company. Law requires certain disclosure in financial statement. The external auditor generally comment in these report if such disclosure have been properly made and meet the prescribed standard. The audit committee should pay particular attention to these aspects and brief the board members on such disclosure. These disclosure about related party transaction, disclosure about the director of the company interest in other company, about the directors or spouse having any interest in the company or having any shareholding in the company. These disclosures are required by the law to be disclosed in financial statement. And monitoring the internal control process. It is the responsibility of the management to design and implement internal control policy. The audit committee has assigned the task of monitoring the adequacy of such internal control. Audit committee should ensure that the internal control procedures are properly drawn up and cover all the essential part of the company activities and record. For this purpose, they can interact with the management, and if they so feel, they can get external help as well. Audit committee, when satisfied with the comprehensiveness of internal control procedure, the next step is to ensure that these procedures are actually being followed and enforced with consistency. For this purpose, regular internal audit are carried out by the internal auditor. However, internal audit is also part of the management team. The audit committee should therefore meet regularly and formally with internal audit team and go over all their reports to ensure full compliance with the already procedure laid down in the papers. The audit committee can then inform the board about weaknesses of the system if he found any weaknesses in the internal control system. Oversight of risk management process of the company. Company exposed to number of risks that threaten its profitable operation or even its existence. The management must identify and seek means of addressing these risks. For example, the risk of fire at the company factory or plant can be handled by designing suitable preventive measures and taking out adequate insurance policy. Similarly, risk related to other operational activity can be mitigated or covered through other available means like insurance, hedging options, diversification, proper preventive and safety measures. Management must formulate procedures and system for this purpose. The audit committee is responsible for overseeing all these procedures and their effective implementation. These are highly technical matters and audit committee need to be extremely careful in dealing with them. Besides this, external professional help may be taken. The board of directors depends on the audit committee to remain aware of risk management, efficiency of the company. Also, company can even hire external person or external expert to assess their risk. Moving to next slides. Terms of reference of audit committee. These are basically laid down by in the revised code of corporate governance. Although the slide is glutted with a lot of information, but this is law and that should be teach in their wordings. So term of reference of the audit committee is determination of proper measure to safeguard the listed company assets. That is first. Review quarterly, half-yearly and annual financial statement of the listed company prior to their approval by the board. Some point I discussed earlier. Review of preliminary announcement of the result prior to its publication. When financial statement is going to be published, it is reviewed by the audit committee. Facilitating external auditor and discussion with external auditor of a major observation arising from interim or final audit and any matter that the auditor may wish to highlight in the absence of management where necessary. So audit committee facilitate external auditors and discuss matter with them. Review of management letter. Management letter is basically letter of weaknesses that is issued by external auditor at the end of when external auditor finishes their audit. So issued by external auditor, management responds thereto. Ensuring coordination between internal and external auditors of the listed company. Scope, extent of internal audit and ensuring that internal audit function has adequate resources and is properly placed with the listed company. Consideration of major finding of internal investigation of activity such as fraud, corruption, abuse of power, and management response thereto. All these things are considered by management committee. Ascertaining that the internal control system including financial and operational control accounting system for timely and appropriate recording of purchase and sale receipt and payment asset and liability. Review of listed company statement on internal control system prior to endorsement by the board of directors and internal audit reports. Instituting special projects, value for money studies, and other investigation on any matter specified by the board of directors in consultation with the CEO and to consider remittance of any matter to external auditors or any other external body. Determination of compliance with relevant statutory requirement. Statutory means that are required by company laws. Monitoring compliance with the best practices of corporate governance. That is one of the report that is issued in financial report. It is monitored by audit committee. Consideration of any other issues or matter is maybe signed by the board of directors. This is all about today's lecture. We'll catch you in the next lecture. Thank you.